The U.S. is adding $1 trillion to the national debt every 100 days, and the interest payments alone now cost more than our entire military budget. Our rate of debt accumulation has pushed us into something called fiscal dominance, a runaway spiral where government debt creates so much new money, and thus inflation, that the Fed can no longer control the economy. In this environment, if you don't own assets, you are being left behind. And most people don't own a meaningful amount of assets. Today, I'm joined by Lyn Alden, one of the sharpest economic minds around. In this interview, she breaks down how fiscal dominance works, why the middle class is evaporating, and what you can do to protect yourself from being steamrolled by a system that is stealing from you. Without further ado, I bring you Lyn Alden. The government spends so recklessly that the average person is now stuck in a world ruled by something called fiscal dominance. It impacts their lives way more than they realize. Can you explain it, though, in a way that makes people sit up and realize that they need to do something about it?
I think one way of kind of thinking about it is that if you're in any way involved in a fiat currency system, as we all are, you're being diluted. It's happening to everyone at different speeds depending on where they live in the world. Obviously, this is going to be mostly, I think, American listeners. We were actually saying right before we started recording that it's a very macro-heavy decade. And so people can kind of ignore finance, but finance won't ignore them. To talk about fiscal dominance, it helps to kind of set the stage for like what is the contrast, which is monetary dominance. So in most financial history that people are kind of familiar with over the past several decades, it's central bank policy and it's their effects on bank lending that determine a lot of the aspects of the business cycle. And what's different about fiscal dominance is that the fiscal deficits are so large and there's such a large existing stock of total debt that the Fed's policies don't work the same way anymore in terms of either trying to accelerate or decelerate inflation. And we get kind of locked into a more persistent type of debasement that you kind of somewhat see in emerging markets. And so we get kind of a version of that, like a lighter version of that in a developed country. And so the reason people have to care about it is because when we're running very large deficits, there are those on the receiving side of them and those who are not. And if you're not on the receiving side of them, it really pays to have some sort of protection against it or to be aware of how the mechanics of that are working.
Okay, so one thing that I'm always trying to get my audience to understand is that the reason that the middle class has been eviscerated is that inflation is not a law of nature, which much to my embarrassment is basically what I thought. That was just sort of the algorithm running in the back of my mind. I didn't realize that we were creating inflation. It's not a law of nature. But it does, when you called it debasement, it reduces the amount of things that you can buy with a dollar, is a really easy way to think about it. So the way that eviscerates the middle class is that it basically forces you to own assets to avoid the negative effects of that inflation, the debasement. So when we think about shifting into fiscal dominance, why is that so much more troubling than being in monetary dominance where the Fed can remain in control? Like you've talked about this as the train has no brakes. So what are the brakes historically? And then what have we done that has ripped those brakes off?
Right. So throughout most of kind of the past several decades, when the central bank perceives that inflation's higher than they'd like it to be. And a lot of this is arbitrary. Like even their targets of where they want inflation to be are pretty arbitrary. But in the US and globally, they've decided on certain numbers. Currently 2% is at least the way they measure it, their target. When it gets too high, they have a variety of tools to try to slow down that inflation. And primarily what they go after is to try to reduce the amount of bank lending. Because in our current fractional reserve banking system built on top of central banking, when a bank lends money, it actually creates money, broad money.
Thin air.
Exactly, yes. And so, for example, in the 70s, which were a well-known inflationary decade, there were multiple things that contributed to the inflation, including, for example, oil shortages. But a key background thing was that there was an above average rate of bank lending happening and therefore an above average rate of money supply growth happening. And that had a lot to do with demographics. The baby boomers who were young at the time were entering their home buying years, which is kind of the peak period of credit formation. And so that was a more inflationary time. And what central banks typically do when they're experiencing this higher level of inflation is to try to slow that down somewhat. They'd rather have a recession than let it just get completely untethered from expectations. And so they raise interest rates.
Bubbles like form? Like what are they trying to protect against?
They're trying to protect against people totally losing faith in the currency, because weakness can beget more weakness. Kind of like how in nature, if an animal's weak, predators will go after that one. The same thing happens to currencies, especially emerging market currencies, but it can happen to developed ones too. Which is if a currency is weak and it's devaluing quickly, and the money supply is growing quickly, and the interest rates are not sufficiently high, then actually more people will come in and borrow it. And buy almost anything else with it. They'll buy another currency potentially that yields better, or they'll buy gold or real estate or pretty much anything that they perceive as being more scarce and likely to appreciate relative to that currency. And that ironically creates even more of that currency. So weakness begets more weakness, and they try to short circuit that by raising interest rates to try to, one, strengthen that currency relative to some others, and two, to make it less desirable to borrow it under more circumstances. So some entities are borrowing it, but they're basically increasing the hurdle to make it less desirable to borrow. And that is an attempt to slow down the money supply growth. What's troubling about fiscal dominance is that so during the 70s, when they raise interest rates like that, it has kind of two effects, but one's bigger than the other. So the bigger effect is that it slows down bank lending, which is what they're trying to do. The negative effect is it actually increases the federal deficit because the government's interest expense is now higher. They're paying higher average interest on their existing debt. And so they're actually ironically increasing their deficit, which could be inflationary. But their total bank lending is a much bigger negative effect than that deficit. The problem in fiscal dominance is that's reversed. So in the current era, the U.S. government's average annual fiscal deficit, like how much the difference between our taxes and our spending, that's a bigger amount than net new bank loans in a given year. And it's even bigger than the sum of net new bank loans and net new corporate bond issuance. Whoa. So basically, public sector credit formation is now bigger than the private sector by several ways of measuring it. And the problem is that when you have over 100% debt to GDP, unlike the 70s where they had 30-something% debt to GDP, so now you have over 100%, when the Fed raises interest rates to try to slow down bank lending and try to harden the currency, they actually blow out the fiscal deficit by an even bigger number than they slow down net new bank loans.
And just for people that aren't super familiar with the word fiscal, fiscal literally means the government spending. So when we say fiscal here, we're just talking like government debts are getting crazy. And so if you try to rein in the private debt creation by raising interest rates, you're actually raising the amount that the government has to spend to meet the hurdle of the ever increasing debt because they're bringing on more, the interest payments begin to compound. And so hence the runaway train. That's wild.
And you get a fiscal spiral. And what some people, like listeners, might be thinking right now is that people have talked about this for decades, right? They've talked about the debt's going to be a problem one day, and it never really seems to materialize. And one thing I've been kind of emphasizing when I point this out is that some things have materially changed in recent years compared to when that was being said. So the peak zeitgeist for the public debt being a problem was back in the late 80s and early 90s. That's when the famous national debt clock went up in New York. That's also when Ross Perot ran the most successful independent presidential campaign in modern history, and it was largely on the debt and deficit as a big topic. And that was kind of the peak zeitgeist. And if you look at interest expense as a percentage of GDP, like federal interest expense, it was basically peaking back then because we had growing deficits and we also had very high interest rates. And so it was pretty fiscally problematic. But over the next 30 years, we had the end of the Cold War, so the fall of the Soviet Union. We had the opening of China. So we had these pretty big disinflationary forces in the world. We had all this kind of Eastern resources and labor, Western capital. All these things were able to come together. It was very disinflationary and productive. Interest rates were able to fall for the next 30 years. And if you increase your debt, but you cut your interest rate in half, your interest expense remains manageable. And that's basically what happened over and over and over again. And what changed more recently is a couple main things. One is we kind of ended a 40-year cycle of ever lower interest rates. We kind of bounced off zero. So even if we just go sideways now, we don't really have that offset the way we used to. So we used to have rising debt, falling interest rates. Now we have rising debt and interest rates that are roughly sideways. And so we don't have that offset. And then two, our demographics changed. So now the baby boomer generation, which in the 70s and 80s were in kind of the peak home buying period, now they're in drawdown of the entitlement systems. So Social Security, Medicare, and so they're and that's being spent largely into the economy. And so those two really big factors are what changed over the past 30 years or so compared to when people were warning about this decades ago.
Okay, so how, from a like raw numbers perspective, how does it compare back in the 80s and 90s when Ross Perot is making a ton of waves by saying this is a problem, and now?
So the federal debt bottomed in the lower 30% range for debt to GDP, and then throughout the 80s that was increasing into the early 90s. It was still fairly low back then, and that's when interest rates were high. But starting in the late 90s, that's when the combination of slower interest rate, like lower interest rates, slow down that interest expense by the government. And then also they did a variety of kind of smaller things to actually give us kind of a period of a surplus briefly. That was also peak demographics. So it wasn't just the policy mix that made that possible. That was the combination of obviously the tech boom at the time of very high level of productivity growth. And then also the baby boomer generation was kind of in their peak earning years. So if you look, for example, at labor participation rate, it peaked around like the late 90s, early 2000s in the country. Kind of the multi-decade peak was right there when we had that surplus. So it's kind of like everything going right together. And in terms of raw numbers, right now, basically, we're running this kind of 6 to 7% of GDP deficit, which you normally only see in recessions. So the biggest ever deficit we had was during World War II. The second biggest was around the COVID era. And generally speaking, you only hit these kind of higher single-digit levels and occasionally double digits during recessions or wars. So the fact that we just have it as a baseline now, largely because of interest expense, kind of normal military spending, and then the entitlement systems, that's where we're kind of entering a territory that's pretty unusual. And another quantification point, of course, is that our interest expense now exceeds military spending, which is generally not a good look for the history of empires. Doesn't look great at that point.
Yeah, putting it mildly. So I don't know if you know the exact number, but to orient people, we are now at 122% debt to GDP ratio. There's sort of a red line when you look at historicals of 130. So when countries hit 130% debt to GDP ratio, they tend to move pretty rapidly into internal violence. And the reason being that you're just getting into that inflationary spiral. You're doing like what we're doing now, where you're hollowing out the middle class. You're getting this insane amount of wealth inequality, which just absolutely drives people nuts from a psychological perspective. And they tend to get revolutionary, literally. Where were we? Like when this was peak zeitgeist and you've got Ross Perot doing his thing and there's all this popular support behind him screaming about debt to GDP. Were we anywhere near where we're at now?
No, that was back in the 40s, 50s, 60% range for debt to GDP.
So what is happening now? Like, how have we been bamboozled? Because I feel like I am trying to get people to pay attention to this, and they're not. There's not. You're now in a populist moment where you're getting a Trumpian figure that rises up. Instead of somebody who's saying we're going to be fiscally responsible and reduce government deficit, he literally tweeted out, hey, I know you guys want to cut spending and so do I, but we can't cut too much because we have to be reelected. I was so traumatized by that tweet. So why back then were we able to get people to realize, hey, this is an escalating problem? And now, like, I feel like I'm banging the drum as loud as I can. You're far more eloquent than I, but we're not able to get like the average person to recognize, I'll say it, and you may not even agree with this, but to recognize that the government is the problem. The policies that we are voting for are the problem. And if we don't unwind the deficit spending, we will never escape this problem.
So I think the reason why it's harder for people to get it is because it's gone on longer than a lot of people expected. And like I said before, it kind of becomes, if it takes so long to manifest, people say, well, maybe those people were overblowing the concern. So back in the late 80s, early 90s, I mean, we were hitting like $1 trillion in debt for the first time. That was a pretty big psychological number, and then you quickly add the second trillion around that time frame, and there's just more awareness of it. And what it kind of differed at that point was you had multiple decades of declining debt to GDP after World War II. And in that kind of like the late 70s, early 80s period, that's when you started to have a trend reversal. So that started to concern people. And then, like I mentioned before, the interest expense as a percentage of GDP was pretty high, even though the public debt was lower as a percent of GDP. Just because if you're paying 10% interest, it's easier to have a high interest expense than if you're paying an average of 2, 3, or 4% interest. And so a lot of people back then were warning that it was going to be a grave issue. And to the kind of the devil's advocate would say, well, what happened to those people? They were saying, it's an imminent problem in, 5, 10 years. And here we are 30 plus years later, depending on what starting point we're looking at. And it's not been a crisis. People also point to Japan, which has well over 200% debt to GDP, and say, well, if nothing's catastrophic happening to them, why should we worry here? What I kind of say to push back on that is it's less about an event. It's less about this one big crisis that happens, like the whole world agrees to sell off U.S. bonds at the same time or something. Instead, it's more of this gradual negative impact. And so, for example, you mentioned the rising populism. I would generally argue that's a byproduct of some of these trends that have gotten in place for quite a while. So the fact that the deficits are running 6 to 7% of GDP every single year like clockwork now, that is already having effects, particularly, for example, that fuels debasement. Meanwhile, the Federal Reserve is trying to keep interest rates tight, which ironically locks younger families out of the home buying market, because these consequences do matter. And so as these kind of big policy gears are switched, there are winners and losers from them. And you generally get just that more rising populist aspect. And then you get often less productive at certain things. You get more violence. You get less kind of just unification in the country. And it's Japan, for example, I mentioned them, that people point to them and say, well, they managed to not have a crisis despite having higher debt to GDP. And the issue there is that they have a lot of things going for them that are somewhat different. So, for example, they have a structural trade surplus that kind of offsets some of their debt issues. They've also got a very homogenous population, therefore more kind of culturally unified, able to get through things. And then two, they have had basically not a good economic run for quite a while. So they are suffering ill effects of their policy as well. And so basically, I think that as the whole world kind of enters this more fiscally dominant environment, at least the whole kind of developed world, the effects will probably be persistent and here. And it's different than saying, things blow up 5 years from now. It's saying that the effects are already here. They're already out there. They're already affecting grocery prices. They're already affecting, how easy it is to move around society and things like that. And it's probably going to keep happening for quite a while.
Yeah. That's a really good point. This is something I don't think people understand about the Japanese in particular. So you'll often hear the stat thrown around that 98% of the countries that have existed in a meaningful period over 130% debt to GDP have ended in revolution. The 2% is Japan. So Japan is like the one release valve, but then they also stayed behind at the World Cup to clean up the stadium. No other country does that. So to your point about that unification, what ends up happening in these countries, and the reason that I'm so eager to get my audience to like really take this idea seriously, that you cannot evaporate the middle class without massive consequences, is I always thought that the end result of bad fiscal policy was going to be that you go to war with somebody else, that the outside world recognizes your weakness and they attack you. But what actually ends up happening is you attack yourself. And so people begin tearing themselves apart from the inside, and they specifically do that because of wealth inequality. And when you look at the mechanism that's happening between why the middle class goes away, is it isn't that they all get made poor. It's that part of them understand, like just rough math, half of them understand, I have to own assets. Like they get what inflation is. I have to own assets to escape this because the dollar is going down in value. So I need a thing that holds that value. It could be a house, could be Bitcoin, whatever, but I need an asset that's going to it will optically look like it's going up in value, but it's really your dollar's going down. But they get that. So they're being pulled up into the upper class. And then half of the middle class don't understand that. And the only thing that they get intuitively is own a house. I can live in it. If you could live inside of Bitcoin, this would be very different, but you can't. And so they get a house, like just intuitively. You don't have to tell them that it's an asset. They don't have to understand inflation. They just know, I want to buy a house. I want to live in it. And so in doing that, when that works, they can stay in the middle class. Once, you mentioned this a minute ago, once that house becomes impossible for them to buy, now all of a sudden they get pulled down into the lower class because inflation is eating away their ability to store wealth. And it's like, man, if we can get people to understand that, okay, that creates this wealth inequality. The wealth inequality makes the have and have-nots hate each other. I mean, basically the have-nots hate the haves. And then they end up revolting. Literally, it becomes bloodshed, the whole nine. Like, it is absolutely wild. And so heard that it just happens so slowly. This is how you boil a frog. And so now everybody is like, I've heard people screaming about this forever. But it's like, if you're mad because it did come to fruition. It came to fruition slowly, but it actually did happen. And so we're now in this moment. And when you look at that, how do you contextualize someone like Trump? So are Trump's policies going to help us out? Are they going to hasten the decline? Like, where do you fall on that?
I tend to be of the observation that I think he identifies a lot of the issues correctly in the sense that, for decades, for example, the trade deficit was ignored by politicians of both the right and the left. Running a trade deficit for a period of time is fine for a country to do. There's all sorts of reasons it can happen. But the U.S. has kind of a specific kind of built-in mechanism to always run a trade deficit. It's actually kind of tied to our reserve currency status. There's basically so much external demand for our currency that the way we ironically get currency out into the world is by running this really persistent trade deficit with the rest of the world. But when you have that for 4 decades in a row, you basically hollow out certain parts of the country and kind of reinvest it into the cities, basically. So you kind of hollow out, Michigan, and you reinvest it in New York and Silicon Valley, and that's kind of where all that wealth winds up. And then the same thing happens with the fiscal deficit as well. And so I think he's identifying some of these things, like the trade. He kind of elevated the trade deficit as being something that Hard Landman talked about to now kind of front and center in politics. But I also tend to view that the things done don't tend to necessarily address the actual things he's identifying. So in both his first term and his second term, generally the fiscal policies would even further help the top couple percent out, more so than
he tax breaks, continued spending. Is that the specific part of the fiscal policy you're talking about?
Yeah, that tends to be skewed toward the wealthy, either the older or the super high net worths, for example. And then, the tariff policies are tricky because even though I think that addressing the trade deficit is a real thing to do that we've actually not really seen a lot of politicians interested in, the mechanisms to do it don't seem particularly well thought out. And I think that therefore the probability that they meaningfully kind of improve things in that sense over the next 4 years is pretty low. So I think that's the challenge. And the problem is that when you have this kind of, when you reach this part of the economic cycle, so when you have a very top-heavy entitlement system, you have a very top-heavy public debt, you have these issues, every kind of year or every kind of congressional presidential cycle we spend still not getting it right kind of digs us further into the hole.
We'll rejoin the show in a second, but first, here's what kills most successful companies. They grow faster than their systems can handle. Revenue's climbing, but suddenly everything is breaking. Your accounting software crashes during month end. Inventory tracking becomes a nightmare. Your team's drowning in manual workarounds just to keep the lights on. And that's why over 42,000 businesses have future-proofed their operations with NetSuite by Oracle, the #1 cloud ERP, bringing accounting, financial management, inventory, and HR into one unified platform. When you're closing the books in days, not weeks, you're spending less time managing chaos and more time scaling intelligently. Whether your company is earning millions or even hundreds of millions, NetSuite helps you respond to immediate challenges and seize your biggest opportunities. And speaking of opportunities, download the CFO's Guide to AI and Machine Learning at netsuite.com/theory. The guide is free for you at netsuite.com/theory. And now let's get back to the show. Okay, so I've heard you talk about the tariffs as like, okay, nothing's going to stop this train, but tariffs at least are effectively a tax that help slow the train down a little bit. Given that you've said that, but you also just said that, and I don't think this guy is really thinking through these policies well. Help us understand your take on tariffs as a tax and whether that's the right way to look at it. And then if that's not quite the right way to do this, or maybe not the right way at all, what would be the right way to use policy to slow the train?
A big factor in why the deficits are so hard to resolve, not the only factor, but a big factor, is the political polarization that's embedded in it. So there are a lot of things that politicians don't want to cut, and then there's a lot of defenses against raising taxes as well. Tariffs are kind of interesting because with emergency powers from the executive branch, they kind of bypass that polarization. So instead of Congress voting on this, the president was able to do it. Now, in weeks or months, I mean, it's potential that courts could take that power away. I'm not a legal expert. It's currently kind of being looked at, analyzed, working straight through the court system. But as it is right now, that's basically a pretty unilateral tax increase. So it's able to bypass some of the polarization that happens. In terms of quantifying it, I mean, they're currently running about $30 billion a month in tariff revenue, which analyzed gives you $360 billion. Some of the latest tariffs are not really in that figure yet, so we might end up seeing 400 plus billion in annual tariff revenue, but that's up against a $2 trillion annual deficit. So you're talking something like a 20% dent into it. The other factor that's complicated is that it's being marketed as a tax on the foreign sector. But right now, the majority of evidence shows that it's being paid both in the literal sense, but also even economically paid by Americans in multiple ways. It's sometimes in the form of higher prices, other times in the form of businesses taking a margin hit, for example. So far, we've not seen a reduction in import prices to offset the tariffs that are being paid. So this is primarily a new tax on Americans. On average, it will tend to be more felt by those, again, in the lower income spectrum, because if you're wealthy, generally your consumption's a smaller share compared to your wealth and income. Whereas if you're on the lower end of the income spectrum, most of what you earn goes toward consumption, which is now potentially, at least the import portion is more tariffed. And so those potentially minor price increases actually matter a lot more. How I would actually go about addressing it, that's always the hard part, because I for example, I'm first to say it, like, that the central bank gets a lot of criticism, and I'm pretty critical of central banking in general. But for example, I wouldn't necessarily know how to handle it better than the current Fed's doing, because when they're stuck in fiscal dominance, a lot of their tools are taken away. You cited that statistic before, that once you reach roughly this high debt to GDP, 98% of the time, you have an issue. And that specific study, what that points out is that 98% of the time over the next 15 years, there's some sort of default. It could be a literal default, which sometimes you'll see among, say, emerging markets, generally entities that cannot print the units that their debt is denominated in. But if it's the country's own currency, they're more likely to default through debasement. They basically default in terms of purchasing power. And to some extent, we've already started that process. The last 5 years were like the worst ever period for like bonds in like modern American history. For example, bonds underperformed practically every other asset. And so I think the first step is actually just being fully aware of what's happening. And I unfortunately don't have good answers for how to resolve it. I think the trade deficit is potentially more resolvable than the fiscal deficit, which is to say, if they start doing policies that discourage the global capital kind of stuffing itself into U.S. capital markets, that can alleviate some of the artificial strength on the currency that makes it really hard to manufacture things here profitably. And so that's an angle that could be tackled. But so far, that's not one of the levers that they're pulling. And it's interesting because Trump's chair of the Council of Economic Advisors, he actually wrote a paper on how one might go around reducing the trade deficit. And he published that in November 2024. So right when after Trump was elected. And that's kind of like their Steelman approach for how they're going to do this. That's basically the Harvard economist view of, okay, if you want to try to enact Trump's goals, how do you go about doing that? And that involves some degree of tariffs, mainly to bring negotiating up with other countries, and then use a variety of other things to dissuade all of that capital from being stuffed into U.S. capital markets. But they haven't done that part yet, and I kind of don't think they will, because that's the part that is also pretty painful. Most
why
holders
would
of
that be painful?
Because holders of assets generally like the fact that there's a lot of foreign capital coming up and bidding up their assets. And so it's one of those things where there'd be some parties that are benefiting from it, other parties that are hurt by it, and kind of like any other polarized topic, there'd be defenses against that happening. Basically, that they wouldn't perceive that as something they want to probably do.
So I get why, as somebody who gets the asset side of the equation, you got a ton of money in assets. But if the case could be persuasively made that, hey, keep pushing on wealth inequality, and the French have a story to tell you about the French Revolution where wealthy people got their heads detached from their bodies. Or, hey, compelling argument would be, let me show you how stopping the inflows of capital into the American financial markets actually help the poor and working class, and that lets you keep your head, which is my message. How exactly would pumping the brakes on the amount of money coming into the U.S. financial market actually be pro middle class and working class?
Yeah, good question. Basically, we can back up and kind of explain the mechanism. So right now, the dollar is the global reserve currency, which basically means that the whole world wants it for a variety of purposes. They want to hold it. They want to use it for international contracts. They use it as the basis for most currency trades. So most currencies are actually not very liquid with each other. Like say Egyptian currency and Korean currency, not a very liquid market, but they're all pretty liquid with dollars. So you can always trade one for the dollar for another one. And international financing. So if an entity in France lends to an entity in Brazil, it'll often be, for example, in dollars. So there's this kind of global demand for dollars. And the mechanism of how they get that is that basically the U.S. runs these really big trade deficits with the rest of the world. And that's importantly something that the U.S. has purposely facilitated. So it both happens organically, but then also the U.S. kind of leaned into that historically. And then the way that works is they basically overvalue the dollar. So most currencies, they will trade on things like interest rate differentials. They'll trade on things like their current account balance and all that. The U.S. dollar, because it has this extra demand for it, it tends to run this more persistent trade deficit. So we overvalue our currency, we give ourselves a lot of extra import power, but we make our exports less competitive than even our other developed peers, generally speaking. And so we run these persistent trade deficits with the rest of the world. We kind of spew out dollars into the world, and then the rest of the world takes those dollars and then they buy our financial assets with them. So they buy our equities, they buy our real estate, they bid up our asset values. And the problem is that if you live in New York or parts of California, you're probably doing great. It's your assets that are getting bid up by this recycled trade deficits coming back into our markets. But if you're anywhere in the Rust Belt, it became the Rust Belt for this reason, basically. If you're anywhere in kind of heartland, your economic prospects have been more impaired. And so it's kind of siphoning from one place, putting it into another. And any sort of attempt to reduce capital inflows into stocks, into asset values, that's generally going to be pressured against. But by bidding up home prices to very expensive levels, it makes it's good for those that have a home, and it's good for those who've been able to lock in a short, like a long duration fixed rate mortgage against it. But it's very bad for those who are trying to enter the home buying market for the first time. This is also generally something you see in countries like Australia or Canada, where they have a policy of kind of trying to keep prices elevated, just because so much of the country kind of has their wealth in real estate. But then the losers that are those that are trying to buy a house not for investment purposes, but for the actual utility purposes of using it. So generally speaking, the trade deficit has kind of been rewarding to those with financial assets at the cost of those who want to work in the Main Street economy in many ways.
Okay, so I saw how that would play out in the housing market. That obviously, to me, is a thing that screams from the void to be addressed. Again, going back to that idea, this is what the average person understands intuitively. You don't have to explain to them assets and all that. But if we were stopping things from coming into the financialized side of the economy, how would that alleviate pressure directly on housing? Could we not, through policy, make housing less of a problem? Like, for instance, deregulating, so it's just easier to build more housing. Would we have to stop things coming in, stop people from cramming dollars back into the U.S. financial system?
So a lot of it is that basically the dollar is kind of artificially overvalued because of this demand for it. And that's what kind of directly makes it hard to make things here. So right now, with a lot of our policies, we're addressing the symptoms of this structure.
So it's really about driving manufacturing back to the U.S., giving the average person a place to work, and the like sort of heartland company that makes, this is a terrible example, but steel, brake pads, whatever. And now that's going out to the outside world. So more than it's necessarily influencing just asset prices, it's just making it possible for somebody in the middle class to earn a living, to have that small company that exports that thing. Is that the idea?
Yeah, it basically balances the economy a little bit more. Basically, the U.S. has a lower share of manufacturing relative to GDP than many other countries because that's the part that we've kind of exported. And if you didn't have this capital recycling structure at the scale that we currently have it at, some of that would be able to flow back in. Now, realistically, a lot of that would be automated, but basically you have a more balanced economy at that point, and you're kind of less extracting it from certain states and then kind of reinvesting it into other states. There's also a really big wealth effect that happens, that basically that the higher our asset prices go, it kind of fuels consumption from those with assets. At kind of the cost of those who don't. So we have these kind of really big mechanisms in place, and some of them seem good on the surface, but then there are losers from them. I mean, even for example, the home buying, a lot of times you'll hear about BlackRock buying homes, for example, but a lot of the funds, so that's kind of the one example, but there's a lot of funds and pools of capital buying homes, and some of that is actually foreign capital. Because in addition to buying our equities and buying our private equity, they're also, in many cases, buying our property. So basically, you inflate the property values at the cost of people that want to enter them. So we have this kind of unusual current cycle where home turnover is very low right now. So there's relatively few sellers, relatively few buyers. There's not a lot of activity happening, and yet prices are still pretty elevated because there's that kind of persistent bid there, and that's kind of it benefits those who have houses, obviously, but it's harmful for those who want to get them, and so that's why we end up having one of the highest historical ages for first time buying a home.
That's very interesting. That feels a little counterintuitive. Let me make sure that I understand this. So if you had said that the appetite for property has remained high, even though interest rates are high, and that's sort of illogical, and how could that be? We're hollowing out the middle class who's buying these houses. Oh, P.S., this is foreign investors. I would have said, okay, yeah, cool, that makes sense. But if you're saying that activity is actually low, how is the perpetual bid from foreign investors meaningful if nobody's buying and selling?
Because there is still some buying, and a lot of those are able to do cash buys. So right now, the limiter to a lot of changing of home ownership is the fact that the mortgage rates, someone would have to get out of a low interest rate mortgage. They would end up in a higher rate mortgage if they move. And then the buyer has less kind of financial firepower because their monthly payments are so high. But it doesn't really affect too much the cash buyers, those either because they're wealthy or because they're investment funds that are able to come in and just pay the cash value for the house, and therefore around the margins still keep those home values pretty high.
Okay. So given that one of the things that's really impacting both the ability for somebody to own a home and the government debt, the fiscal debt, is Trump right to call for the lowering of interest rates, or is Jerome Powell actually wise to be holding off?
In fiscal dominance, almost everything the central bank does is wrong. That's the problem, is that because if they hold interest rates high, so go back to kind of what we said earlier, the primary purpose of raising interest rates is to slow down bank lending. The problem is that the whole period of inflation we've had for the past 5 years was not caused by excessive bank lending. It was caused by those fiscal deficits. Originally, it was intentional stimulus, and now it's just kind of this background higher deficit. So the Fed, in some ways, has been trying to raise interest rates to slow down bank lending to offset the real problem, which is the federal deficits. But by doing so, because the debt's over 100% GDP, by keeping interest rates high, they're also actually keeping the deficit high because they're keeping federal rates high. And yet, if they cut interest rates while you have stocks at all-time highs, gold at all-time highs, Bitcoin at all-time highs, property values at all-time highs, then they're adding fuel to the fire too. And that's why you get to that statistic where 98% of economies, when they reach these debt levels, tend to have some sort of default, which can be through purchasing power, because their own central bank kind of runs out of options. And so I think that, it's probably due for a mild cut, just based on the deterioration of economic conditions. But I view that as a smaller lever to pull than the fiscal situation. Kind of one way of putting it is that when the money's weak, people will monetize other things. And then by doing so, they make those things less available to those who just want to hold them for their actual utility use, not their monetary use. And so by monetizing our equity market, by monetizing our real estate market, because our money's weak, it causes all these more structural imbalances, and therefore it causes periods of malinvestment, and it causes that kind of, along with other policy decisions, those high levels of wealth concentration.
Okay, so if I'm understanding you correctly, the way that Jerome Powell is looking at this, he knows what you know, which is I don't really have any great options. But the one thing that if the real problem is the government is taking on too much debt, that's causing them to print a bunch of money, that's causing the high inflation, then it seems like I should be trying to pull down the interest rate. Obviously, I need to find a sweet spot, but I should be trying to pull down the interest rate, knowing that I'm going to have a bigger impact on the government, certainly at first, than I would have on the banks then suddenly going crazy, because I have a bigger problem with the accrual of compounding interest, because we're adding right now $1 trillion every 100 days to the government deficit, which is just absolutely insane. So why wouldn't that alone be a signal to bro, look, there's obviously a breaking point, and then you're going to trigger the private market too much, but we've got to bring this public debt interest payment down?
I think because the optics are so bad. Like a key part of central banking is that they're supposed to have some degree of kind of optical independence, which is that they're focusing on their mandates, employment levels, inflation, things like that, and they're not really supposed to take into account the fiscal situation of the country. And yet, in practice, of course, you find that they, when the rubber meets the road, they do. So when there's a war, when there's a fiscal crisis, the central bank's options shrink, because at the end of the day, they have to kind of support that bond market. And so we saw this, in recent years. And basically, from their perspective, they can't say out loud that because the debt's a problem, that we have to kind of change how we would otherwise do things. And I think actually, like that, going back to my prior point where I would say it's hard to criticize the head of the central bank, even though I'm kind of critical of the whole practice of central banking. The one thing I think that it's fair to be critical of is the asymmetric talking point they've had around the fiscal deficit. So, for example, during COVID, during the depths of it, the head of the Fed called for more fiscal. He basically said, our tools are limited here, given what's happening. We need more fiscal spending. And they got that. There was, of course, very large stimulus efforts. And now on the other side of that, they won't go out and say that the opposite. They won't say that our ability to control inflation and kind of tweak all this is being hampered by the fiscal side. That basically our tools are not geared to doing that, and if anything, could make it worse. So they have to kind of show confidence and say, look, we got this, our tools can fix this. But the problem is that I think it doesn't. That basically that their tools are largely unrelated to what the core issue is. And I think that the first step is basically to say that, and they're not doing that part.
That's interesting. So let me give you my layman's counterpoint to this, which would be, I'm the Fed, I'm Jay Powell, I look at this, and I know one simple thing. If I jack up interest rates, you're going to have to spend less. because you are going to hit a point where it is just absolutely untenable for you to keep spending what you're spending? Is it that Jerome Powell knows, oh, we'll hit a political crisis first, they'll oust me, they'll find some way, they'll oust me before that? Because other than that, like, this is one of those where he once said something akin to, I want to be in a position where I can raise interest rates because it's essentially breaking the leg of the economy and I know how to heal a broken leg. So he gets that that's exactly what would happen. So why isn't he doing that? If he's really trying to control inflation, he has to do that.
Yeah, I think that's what he has been trying to do, which is by holding interest rates high, it makes the dollar fairly strong compared to other currencies. It kind of puts pressure on the rest of the world. It does keep commodity prices in check. For example, oil, generally speaking, it's hard to have out of control inflation if oil prices are pretty low, which they are. So it's having those effects. But then the problem is it's grinding out more and more of this public debt, which is actually ironically spewing more dollars into the market. The problem is that in kind of no world, if there was like an acute bond crisis, would they kind of blink and just let it happen? Because one of their kind of shadow mandates is financial stability, and that goes at the heart of financial stability. A really good example is the Bank of England, which was under similar strain. So back in 2022, inflation there was like 10%. The Bank of England was going to do a speech around balance sheet reduction, so quantitative tightening, and then the gilt crisis happened. So for people that aren't familiar, the UK sovereign bond market kind of broke. It was just kind of this leveraged vicious cycle. So yields were rapidly rising, causing more entities to sell. And ironically, the Bank of England had to cancel their speech on balance sheet reduction, and they had to go and buy the bonds, despite the fact that inflation was 10%. So they did something that is normally only done in a low inflation environment, and they basically had to do it out of an emergency to maintain kind of just functioning like sovereign bond markets, because everything would have kind of ground to a halt. And I think we would see the similar thing in the U.S. that basically they can try to pretend as though that by increasing interest rates that they would maybe change the fiscal trajectory of the country. But I think in practice, the problem is that the fiscal side would pretty much just ignore them, as they have recently. For example, the Big Beautiful Bill doesn't really have deficit reduction as part of it. The only thing that it kind of some ways is deficit reduction is the tariffs. But basically there's been kind of no change during that process. And if they actually were to get called out on it with some sort of bond issue, I think we'd see the Fed pretty much right in there. We also saw this back during the 2023 regional bank crisis. So inflation was still above target back then, even more than it is now. And if they let banks fail, that does destroy part of the money supply. But they were more worried about the cascading perceptions of bank instability. So they actually went to a period of temporarily balance sheet increases and liquidity provision to put out that fire, despite the fact that inflation was above target. So generally speaking, whenever they actually run into a true crisis, they do generally err toward allowing that inflation, keeping things nominally together, and then trying to slow things down in the future.
Okay, so if I remember correctly, it was Volcker that raised rates north of 10%. I want to say north of 15%. Like, it was wild. He was able to do that because government debt was so low? Like, why couldn't we run that playbook now?
Exactly. He was able to do that because total debt levels, both public and private, were low. And in particular, the primary cause of inflation, in addition to the oil shortages, was that elevated rate of bank lending. So he went after the kind of root cause, which was the accelerated bank lending, and he made bank lending less attractive by raising interest rates. So in addition to solving the oil constraints, that was kind of the 1-2 punch that helped get that inflation under control. The problem in this environment is excessive bank lending is not the cause of inflation, and both in the private market and the public market, debt's very high. So if you jack up rates super high, you actually blow out the deficit even more. And that's for example why Argentina, they had very high rates for quite a while, and it didn't really slow down their inflation or their deficit because it's not a bank lending issue primarily, it's a fiscal issue. So certain tools work when the problem is coming from certain things. So in this case, the Federal Reserve has tools to deal with bank-driven inflation, but they just don't really have the tools to deal with fiscal driven inflation. That's mostly a president and Congress thing, and that's that's the part that has to be addressed, and it's not.
So what I'm hearing is that this is where we realize that the Federal Reserve, the central bank, really isn't independent. Because if the government wants to spend, they are going to spend. Because he has, assuming that there was true independence, the Fed could just say, you guys are $2 trillion a year over budget, and we're going to keep cranking up the interest rate until you balance your budget. And then we will, lower it again. And then the government would be like, oh my God, like this would be disastrous. So we're going to have to balance our budget. That clearly doesn't happen. I mean, I'm hearing you, you're being very clear. Minus a political problem that seems like, basically said another way, when it's people, the private sector that's getting out of hand, too much bank lending, the Fed just slaps them around, raises interest rates until they calm down. But when it's the government doing the same thing, printing too much money, they're like, oh, gee, well, we don't have anything that we can do to stop this. Yes, you do. Raise interest rates.
Yeah, pretty much. If they were willing to let the sovereign default or have basically illiquid action in its bond market, then that could affect it. But kind of if you just look at
it's purely that it's you're going to end up doing a hard default, and that's why we're going to keep going. One, did I understand that correctly? And two, are you like, yes, dummy, that's what they should do?
I actually don't, because it actually ends up hitting their mandate. The problem with the default is then it cascades through the whole system. So for example, banks, they hold treasuries. So if the US government defaults, basically banks risk becoming insolvent. So then people's accounts at the banks risk becoming insolvent. Same for their insurers. Same for retirees, right? That's generally speaking why they wouldn't just say, you know what, let's let default happen. They always instead say, look, we can do a gradual default through debasement and inflation. That's almost how they always do it. And the problem is that if they start doing that approach, which they almost always do and they currently are, but then the actual things remain unresolved. So we have entitlement reform that doesn't happen, or a Pentagon audit and clear out pork in defense spending and make sure that's all right sized. If none of that happens, then it just kind of keeps over time accumulating. And so people, going back to my earlier point, it's not that we have one big debt crisis, it's that we have a bunch of little mini ones all in a row. So for example, that UK gilt crisis was a debt crisis, even though it wasn't the end of England. It was just a crisis that they put the fire out, they kick the can down the road, they'll have another one. And the same thing happens, generally speaking, in the US, where it generally comes out in the form of inflation, comes out in the form of populism. And then the problem is that it just keeps getting worse until there's some sort of pretty radical change. And if you look at public polls, people don't want to cut Social Security, they don't want to cut Medicare, they don't want to cut a lot of these key things. And so I think we have to probably go through a lot more pain before we potentially come out on the other side of this stronger.
We'll be back to the show momentarily, but let's talk about why founders burn out before they ever succeed. You started a business to be great at one thing. Instead, you became mediocre at everything. Designer, copywriter, photographer, marketer, inventory manager, customer service rep. You're not an entrepreneur. You are a one-man circus. Successful founders focus on what they're great at and let experts handle the rest. And now Shopify gives you access to world-class expertise without needing to hire a team. Their AI writes compelling product descriptions and headlines. Their templates create beautiful stores that convert, and their tools handle inventory management, international shipping, and returns automatically. Shopify powers 10% of all e-commerce in the US, from household names like Mattel and Gymshark to brands just getting started. Stop wearing every hat and start building your empire. Sign up for your $1 per month trial and start selling today at shopify.com/impact. Now let's get back to the show. Please paint that picture for me that we come out the other side stronger, because I look at this and it really does seem like it will escalate until there is so much wealth inequality that there is naked violence in the streets. I don't, especially given what you just walked us through, I don't see how that stops. We're going to soft default. That will increase wealth inequality. And then people will get to the point where they're angry enough to fight. How do we come out the other side stronger without real problems in between?
Well, if I could solve that, I think I'd probably not be in the business of analyzing things. It's always easier to describe problems than to fix the problems. I'm kind of fully aware of that. I think basically the U.S. can do approaches that kind of facilitate a changing of the whole reserve currency structure. So right now, they both want the benefits of being the reserve currency, but they don't want the cost of being the reserve currency, which kind of comes with these structural trade deficits and to some extent these fiscal deficits. They don't really want the costs, but they want the benefits. And I think part of it is kind of backing up skillfully from a position of strength rather than being forced to back up later. And so one thing I kind of point out in my book is that most empires, when they kind of get too big and overstretched, they never think, you know what, maybe we should pull back instead of trying to fight and maintain every single border we already have. And instead, they pick the approach, say, no, we have this, we're going to keep it. And then they get death by 1,000 cuts over time. And so I think basically if I were to give advice, it would be to kind of acknowledge the problem, which I think is still not being fully, internalized in the country, and basically say that this is unsustainable and that we have to start pulling back, whether it's kind of global actions, whether it's the structure of our entitlement systems. We have the highest per capita healthcare spending in the world, which is a problem when you enter that kind of late stage demographics. So going back to Japan as a positive example, even though their population is on average like 10 times older than us, they pay far less per capita on healthcare than the United States. And so that's actually one of the biggest things to address for multiple factors, because high healthcare, one, it keeps blowing out the fiscal deficit. And then two, if you're talking about, why can't we make things here, is partially because every American you hire to make stuff comes with a really big healthcare expense burden attached to them compared to even their peers in other developed countries. So not just emerging markets, but other developed countries like Japan, they have that cost advantage on labor because they don't have that really bloated healthcare system. And so kind of starting to address these at least one at a time, if not together. So basically cleaning up defense spending, making sure that's actually there rather than kind of, like for a good reason rather than pork related, as it often is the case. And then also really tackling kind of the root aspects of the healthcare system, as well as kind of the imbalanced entitlement system. So when Social Security was constructed and kind of put into place, there were way more workers per retiree than there are now. And so over time, as life expectancy increased more than the retirement age, and as our demographics slow down, there's fewer people adding into it than there used to be relative to those getting out of it. And so we've kind of skewed our things toward kind of directing fiscal deficits, ironically, toward those that are older and wealthier, and not toward those that are younger and middle class or lower middle class.
Okay, so if I'm projecting this out well, it seems like what's going to happen is as the baby boomers work their way through the system, that we are going to have to just keep soft defaulting in a really aggressive way to cover all of the expenses that we're going to have to pay for their healthcare, for the fact that they're just not contributing to the system anymore, that the final revelation that this is all a Ponzi scheme makes itself just too obvious to ignore, because neither side has the political desire, while baby boomers are still cognizant enough to vote, to reduce the amount that we put into the entitlement programs. Any dissenting statements on that?
Yeah, no, I think basically we're at the stage where default happens. I would say it already partially happened with the big devaluation of bonds we've seen over the past 5 years. And then the question becomes who gets defaulted on and in what ratios. And so, for example, means testing Social Security is basically a type of default because people paid into it with a certain rule set, and some of the rules might have to be changed. But if that saves the system compared to not doing that, that's one of the things that has to be considered. So defaulting on some aspects of Social Security, defaulting on some aspects of purchasing power, or even actual default of sovereign debt. And then I think that the biggest factors are really untangling the healthcare system and the corruption and the kind of the lack of price discovery that happens in the U.S. healthcare system, as well as defense spending, which again, the fact that we have this, we're going like a lot of, for example, the programs in Doge went after these smaller areas, whereas kind of the elephant in the room is the entitlement systems and defense. And those are things that they weren't really able to go after. And I think that's kind of the big thing to eventually have to go after. And it's going to be painful.
Yeah. So watching the Doge thing was, for me, very eye-opening in terms of the general public. I mean, look, I suppose it just became political, but there was so much vitriol at the idea of going in and cutting. It did not matter what Doge was trying to cut. It was just automatic no, hard pass, like this is stealing from the American people. What was your read on that? Did you just see, it's a populist moment, this is typical political bullshit? Or, how did you read that?
So on my site, I partnered with Sam Callahan. We published a report kind of ahead of time. We started working on it in 2024. We had it out, I believe, in January 2025. And it was kind of explaining why the Doge project would not be successful in terms of major cuts. So we were looking at these headline numbers that they were saying that they were going to try to cut by, either from Musk or from others kind of giving these numbers. And we kind of just walked through the math of why that was very implausible, which is kind of my earlier point that the vast majority of the deficit spending is in these kind of entitlement structures, whereas they want to go after primarily the 15% of the pie chart, which again, there is waste there, but it's kind of like, I think we were kind of doing an exercise in, as a country, telling ourselves that there's all this waste that if we cut, it won't actually impact the things we don't want impacted, and that we can fix the deficit without pain. And I think that was this exercise to do that. And we kind of had to show ourselves that that's not really how it works, that actually these core things that are popular are what's at the heart of the deficit and therefore, partially at the heart of inflation. So it kind of showed that easy answers are not really the way out here. And yeah, those types of things happen, generally speaking, when you start to get these kind of rising populist movements, where there's populism on the right, populism on the left. We start to get kind of things like that, but a lot of it is more optics.
Okay, let me paint a picture for you of what I see is going to happen. You're so deep into the analysis here. I'd love if you see somewhere that I've gone wrong, let me know. The way that I think this is going to play out, so you'll say we need a lot more pain. I think pain takes on a very specific set of actions. I think the pain looks like this. You pull some of the middle class up into the upper class. You yank a bunch of the middle class down into the lower class. The have and have nots are staring at each other like monkeys, where one is getting cucumbers and the other is getting grapes for the same task. They start going absolutely ballistic because it does not appear to be fair. We are having to soft default to cover the baby boom generation. Nobody will vote for a change in the structure of entitlements, which we just absolutely cannot afford. Just mathematically, it is very simple. Given that, they will continue to print more money for reasons that you've made abundantly clear. Fiscal dominance makes it impossible for the Fed to correct this problem. So they're going to make noise. They're going to hold meetings. It's just not going to matter at all. All that will matter is what are the deficits that the government is spending year after year. We will get an unrelenting 6 to 7% of GDP, debt to GDP ratio growth. And we are going to see wealth inequality hit a point where the refusal to make changes to entitlements will cause America to, there'll be political assassinations, which for anybody who thinks that sounds crazy, look at what just happened in Minnesota like 4 months ago. This is already happening. So we're going to see a rise in political assassinations. We are going to see a rise in violence between the left and the right. We're going to continue to see people migrate either from red states to blue states to red states. We will just continue to see this like fracturing, this pulling apart. And ultimately, when we say pain, what we mean is violence. And there will be enough violence that finally people will get fatigued and say, okay, something's got to give. But I don't think that will happen until a sufficient number of baby boomers have died and can no longer cast a vote. I also think, just to really add complexity here, that you're going to see the Democratic Party continue to break socialist. That's going to gain in popularity, which will only exacerbate the violence for reasons I'm happy to explain. But violence is the thing that we sort of gently refer to as pain. Does that sound crazy to you, or what?
No, it's bleak. I think it's realistic. I have the phrase "nothing stops this train," which I took from Breaking Bad, which is basically that this kind of slower burn default / deficit situation is probably going to last longer than people think. And so it doesn't blow up right away, but it also is not fixed anytime soon. I think the first real test for that is in the mid-30s. The Social Security Trust Fund is estimated to run out. And at that point, they would have to be, it's not to say that like the payments just stop. It's that basically they get a haircut. They'd only be able to pay out what they're currently getting in from the tax base at that point, rather
Do you have
than
a sense of how different that is? Like what's that delta?
Something like a quarter or a third. So it's like if every check was basically cut by 25% or so, or if you means tested it and said, look, if you make $1 million or you're a multimillionaire and you're getting Social Security, then that could be part of the part that's cut. It's hard. We'll see how they politically navigate it. Or the other test is they say, well, we're going to print the difference. We're going to keep sending the checks out. And then the train keeps running even further. And so basically the pain is a combination of basically various types of literal violence, but then also defaults on things that people are expecting. Defaults on Social Security are a type of pain. Defaults on healthcare promises are a type of pain. The trade situation kind of right-sizing itself through currency devaluation and other things are a type of pain. I think like the hopeful takeaway that I kind of try to leave people with is that the numbers themselves are fixable. Basically, a combination of right-sizing things, kind of the combination of defaults on certain things is able to kind of, and then actually addressing those core things, the healthcare, the defense, kind of the top-heavy and basically national insurance that we do. Those things are fixable to the tune of something like 20, 30% each. It's not like this big catastrophic change per se. It's just very hard to do. And I think the more dangerous element is when instead of kind of tackling those core things, we all end up hating each other, or we pick a country out there that we hate now, and we kind of are focusing on either the symptoms of what's happening rather than the root cause, which is like at the end of the day, it's things like the really bloated healthcare expense, the top-heavy entitlement systems, the kind of the antiquated defense spending structure, and kind of the way that Congress is kind of incentivized to keep that going. Those are the actual core things, and we tend as a people to get distracted by the noise of everything else that's out there.
I think one of the big problems that we're up against is something I call late stage liberalism, where you have for so long, things have gone so well in the country. I mean, the West en masse, and certainly the US, has done well for so many generations that not only do we not remember a time that was hard, our parents don't remember a time that was hard. Like, you have to get back to my grandparents to remember the Great Depression. And it really does just feel like money grows on trees. And I was writing a video essay about this, and I was like, actually, if it had to be grown on trees, people would have more respect for it. We literally print it out of thin air. It's easier than growing it on trees. And so the very joke we used to make to try to explain to kids that money doesn't come easily is like way harder than what we actually do with money. And so people literally, this is why I think socialism is gaining popularity with young people, is it's like they have no sense of like, this is hard to come by. So they look at the people that have a lot more of it and they're really annoyed because they're like, well, this very easy thing is being given to somebody else. It's not being given to me. That sucks. Let's do wealth redistribution. Let's take it from those guys because it's just, growing on trees anyway. Give more to me and take from them if you have to, whatever. I don't care. But like, let's just make sure that everybody has something, with like a terrifying blindness to how difficult capitalism really is. And the thing that I am always trying to get people to understand is even China realize to pull people out of poverty, I have to use what I call red light, green light capitalism, what they would probably call capitalism with Chinese characteristics. And it's like, that's the only thing. It's the only thing that over and over and over all around the world has shown that works. And we have created an economic situation through, to oversimplify, but through deficit spending and money printing, we have created a situation where people think, oh, well, this is always going to be good. It's always going to be functional. Give me the money. And that's going to accelerate the breaking of the economy. Do you see that same mentality growing in people? Do you see us like not only putting our hand on the stove, but like holding it down on the burner, with the reaction being a more socialist bent rather than austerity? So we're going socialism instead of austerity.
So far, that's the approach, and ironically, it's not just on the left. Even the right, basically owning pieces of private companies, and kind of this top-down tariff approach are basically a top-down type of economic management. So you see kind of elements pop up both in terms of the literal socialist left, but then also more socialist aspects of the right as well. So in some sense, the Republican Party ends up looking in some ways more like the European right, which is where it's not necessarily fiscally conservative, even though there's aspects of social conservatism. And so the parties look a little different than they did, in say the Paul Ryan era of the Republican Party or the Reagan era of the Republican Party, and you see the Democratic side shift as well. I think the thing that the U.S. does have going for it compared to, say, Europe, because you mentioned like when we have these when things go well, we're more likely to make these types of decisions that kind of kneecap ourselves. So I think Europe has a bigger issue around energy. The United States, at least, we have the resources to be pretty energy independent, and to kind of not have that be our limiter unless we want it to be. So I think again we have a lot of the tools here. We have the great geography in the world. We have a great system that really kind of fuels innovation. We have energy, we have resources, and it really comes down to a handful of big pockets of problems, such as healthcare, top-heavy entitlements, defense spending, and kind of more broadly, what we've done, and this is what fuels a lot of the wealth concentration. We've made it so that the most lucrative things that most people can do, unless you're like a top 1%, creator in some way, like a Bill Gates or, some sort of founder. If you're not that, the most lucrative thing you can do is go into finance. And so basically anyone who gets in a position where they basically short fiat currency, so they get into a position either as a wealthy individual or at the helm of a big entity like a company or a fund, where they can short fiat currency at pretty low rates, and then they can buy assets with it. That's basically the most lucrative thing you can do in this current system for the most part. If you're just kind of a reasonably intelligent person. And so we kind of heavily reward the finance sector, and we punish and add all these incentives against the more kind of hands-on parts of the economy. And so whether it comes to rethinking the global status of the dollar, whether it's truly tackling healthcare, defense, these are the things that are actually pretty solvable problems. And just my concern is that we'll constantly be distracted by other things, and 5-10 years will go by and we still won't have meaningfully addressed these issues. And polarization will be higher. People will be kind of focused on potentially the wrong things to be angry at.
Yup. Okay. When I really try to put a playbook together, one is, hey, go invest in assets. You have to do it. But the other is, okay, is there a way out of this? Growth is certainly, you can theoretically, it doesn't violate the laws of physics. You can theoretically grow your way out of this. The only thing that I see on the horizon that is even remotely capable of that would be AI. One, do you see anything else on the horizon, even just generalized deregulation? Or do you think AI has a shot at this? Do you think AI is overhyped? Like, what are your thoughts on growth?
So I think that AI and growth in general extends it. That's part of what allows us to go on so long. And even, before I talked about how like people decades ago were saying the debt's going to be an issue. Part of why it took a while for it to become a more acute issue is because of growth. So like before, it was in the form of connecting, Eastern labor and resources to, West capital and other things, and kind of bringing that all together. That's a form of productivity growth. That's a form of just more efficient systems operating. And automation in general, like the growth of technology, Moore's law, all of that was very powerful for basically enabling standards of living to keep increasing despite the fact that our monetary system was inflating. And going forward, I think that AI can do some of that, especially with white collar work. So we can get potentially more productive in certain areas, and therefore reduce the cost of those things, make them more abundant. The part where I tend to be somewhat more bearish on AI, and this all comes down to time frames, is generally real world in the field. So more the robotic side of things. That I think AI doesn't solve everything in the next, call it 5-10 years. That it can certainly have, it can and will have impacts on small businesses, large businesses, the way consumers do things. It's going to have major impacts on the economy, and in the form of growth. But that the real world interaction is still, I think, going to be slower than people think. We hit certain bottlenecks, technology speaking. So we often kind of think of technology as a smooth growing thing, whereas in reality, we kind of have these more stepwise things. The example I like to use is flying. So for thousands of years, humans made basically no progress on flying. Then they made some progress with, hot air balloons and zeppelins. But it really wasn't until we put aluminum and hydrocarbons together where you go from Wright brothers to man on the moon in a human lifetime. But then we hit a pretty much a stagnation. So, I mean, our fastest, jets were decades ago, both, military jets and commercial jets. There's not been a lot of innovation. We've kind of hit like a soft ceiling in a lot of parts of aviation. It's on the other hand, Moore's law, the growth of electronics and all that field software, that's where we've had the vast majority of our technological gains over the past several decades. And I think we can hit a certain point where, we have all these rapid gains for a period of time, but then we do run into kind of a soft ceiling. So that's kind of my expectation with AI. But like many other people, I have to just look to see what experts in the field are exploring and try to, bring the engineering side I have to bear, but it's certainly not in that particular field. So I can only opine on it to a certain degree.
Right. Well, so let's now go beyond the opining. I have a feeling that you also invest. So in this moment, looking at the landscape, where are you? You like 100% deployed in Bitcoin? Do you spread things out broadly? Do you holding bonds? Like how are you approaching this moment from an investing standpoint?
Yeah, good question. I mean, fortunately, I have better answers there than on what public policymakers should do, because that's always the hard part. The way that I've approached investing for myself and my clients is I generally say a 3-pillar portfolio. So most people are they think of the 60-40 portfolio, so 60% stocks, 40% bonds. The problem is that in fiscal dominance, bonds don't do very well. They generally lose a lot of purchasing power. And so my approach is instead of 3-pillar portfolios, so one pillar is high quality equities. So that part's still the same. One part is hard monies, commodity producers, kind of the more hard asset type of approach. And then the final pillar is cash equivalents. So that is a section that does get debased, but it can be used to kind of protect against volatility and rebalance into the other portions. And that, of course, will depend on how old the investor is. Another way of kind of thinking about it is you take the 60-40 portfolio, you take out some of the bonds and put something like gold in the place, maybe not for all of it, but some of it. And you take the equity side and you take a little bit of the equities out and put in some Bitcoin. That's kind of how I've tailored a portfolio, because in that fiscally dominant environment, those types of monies, those types of more hard assets tend to be winners.
Okay. And how do you conceptualize Bitcoin? Do you think of it as gold? Do you think of it as money? How do you categorize it in your mind?
In some ways bigger than that. I view it as money. It's also portable capital. I think more fundamentally what it does is it solves the problem of fast settlements. And so it kind of solves a century and a half problem that humanity's had. So for all of human history, transactions and settlements were roughly at the same speed. You couldn't really transact any faster than you could move around the world. So transactions happened at the speed of foot and horses and ships. But ever since we invented the telegraph, and specifically when we deployed the telegraph over long distances by the 1860s, we reached kind of this new era where people could communicate around the world at roughly the speed of light and therefore could transact roughly at the speed of light, but we had no fast settlement. So settlement still took the form of literally sending and auditing gold, for example. And so we became reliant for about a century and a half on very centralized ledgers to try to bridge that whole gap between fast transaction speeds and yet still very slow material settlement speeds, any sort of like final delivery. And what is interesting about Bitcoin is that it's basically the invention of fast settlements. It finally allows a value to be sent long distances in a way that's practically irreversible, in a similar way that you'd ship gold and it gets audited and therefore that transaction's done. It's not resting on a centralized ledger's ongoing maintenance. And so that's basically what that problem solves. But then it's up against very large network effects. So it starts in 2009. It's tiny. It's up against the $100 trillion fiat currency system, and so it's slowly growing into that. Right now, even at a $2+ trillion market cap, it seems big, but it's something like 0.2% of global assets. Gold at something like a 20 trillion network size estimated is around 2% of global assets. So I think Bitcoin is going to grow into kind of the role that gold fills to some extent, but then potentially has a avenue to grow further still because it's able to solve things that even gold itself as a money can't solve. So there's certain things obviously gold can do that Bitcoin can't do. You can use it in industry. It has all these kind of practical purposes, but as a money, Bitcoin is in many ways more powerful. It's able to beam around the world in 10 minutes, even faster by using some higher layers. And I think another way of kind of thinking about it is because especially with your audience and in general, anyone who's technologically minded, our first thought is, well, the first technology is going to be the one that gets displaced. It's going to be some later thing that comes and displaces it. And the way that I've kind of conceptualized this is that the really big exception for that is communication protocols. Those so far tend to have a very long life cycle of lasting. So whether it's Ethernet, whether it's simple mail transfer protocol, whether it's TCP/IP, whether it's USB, once these things kind of become dominant in their fields, they tend to they update over time. So what displaces USB is the next USB rather than literally a competitor. And two, the complexity and the fast moving parts, that tends to happen at the periphery or on higher layers, whereas the core of the system itself is kind of very simple. And I think that Bitcoin is kind of following a similar approach, which is this new communication protocol that exists. And in this case, it's a communication of value. And it's achieved basically network effect dominance. So it becomes increasingly less likely that something within its own field will displace it in a similar way that Ethernet and USB and others have kind of achieved dominance. And therefore, it's going to grow into whatever total addressable market it has, which I think is north of gold's current 2% of global assets.
What do you think about people that aren't they either aren't sold or don't care about it as a transactable thing, but they think instead of it as a store of wealth? Does that seem silly, or because Bitcoin is not transacted like money is right now?
Yeah, I don't think it's silly. I think that basically people solve the problem they have. And for most parts of the world, people, when they wake up, they don't have a payments problem. They have a store of value problem. That's something that people in developing countries have. And then even in developed countries, we just have a slower version of it, is where are we going to store our value? So that's something that basically 8 billion people in the world have as a problem. Payment problems, while some people have them, they're way less universal. Most people in developed countries don't think I have all these payment frictions all the time. Now, certain areas do. There has been, for example, debanking. In certain countries, people have the issue. Like I point out that there's over 40 currencies in Africa. There's over 30 currencies in Latin America. So we can imagine in the United States, if every state had a currency,
Oof.
and imagine all the cross-border frictions, not just in terms of payments, but in terms of cross-state lending and things like that. So if an entity in New York wants to lend to an entity in Michigan, and you're balancing 50 different currencies, and so a lot of the world actually kind of lives under that type of friction-filled system. So they, especially in a cross-border sense, you're more likely to have payment frictions. So I think that the problem that Bitcoin is kind of filling into, the thing that it's solving, is more that portable store value problem. So it's portable capital. But then around the margins, it can also solve payment problems for those that have it. But then in addition, that's a crowded field. So for example, stablecoins, not for every person, but for a lot of people, stablecoins solve a lot of their frictions as well. So going back to that example about Africa, like you'll see a lot of stablecoin volumes happening in several countries there, like Nigeria, because especially for shorter term holding and paying, stablecoins are equal or in some cases better than Bitcoin at that specific task. And where Bitcoin really shines is that over that long arc of time, it can't really be sanctioned. It's not centralized. It doesn't debase. It's truly permissionless rather than this kind of centralized node on top of a blockchain. And so I think over time it grows into more of that payments aspect. But I think in the current time where it's high volatility and it's growing into its total addressable market, it more serves as that kind of portable capital aspect.
Okay. Whenever I think about Bitcoin, and my audience will know, but for anybody that's encountering me for the first time, I'm heavily invested in Bitcoin, big believer, but I definitely don't trust myself to be right about Bitcoin in the way that, say, Michael Saylor does. What do you think about the Bitcoin Treasury company's master in terms of that just massive concentrated bet?
So I think it makes sense for someone to do it. I mentioned before that basically in this current system where you have debasing currency, anytime someone can borrow or short fiat currency and go long another asset, as long as they manage risk and volatility well, they get rewarded for it. So I think it makes sense that someone figured that out. You can do it with Bitcoin. It was actually written about by Pierre Richard back in 2014. He wrote an article called Speculative Attack, and he's like, someone's going to figure out that if you can borrow fiat currency and buy Bitcoin, you're just going to keep doing it over and over and over again. That started happening 6 years later in 2020, and it's been happening ever since. And we're starting to see it in other companies as well. So Metaplanet of Japan, a bunch of others. I think that makes sense. I do think that, this cycle will hit a degree of froth in it. And so some of these levered entities will get shaken out. We've also seen, altcoin treasury companies spinning up, which I think, looking back years from now, will probably not be seen as very positive things to have done to, use leverage to kind of stick altcoins in a publicly traded vehicle.
Just because they're going to wipe out value? Why would we look back and say bad idea?
Because it wipes out value. Yeah. I think basically there's been a long history of, altcoins have one or two good cycles under their belt. When they come out, they get launched, they get hype, but then they kind of roll over relative to Bitcoin and then never really recover. So that's been kind of the case over and over and over again. And I kind of expect that to keep happening just because of that communication network effect aspect that I talked about before. So
do you think, though, that with the altcoins that people are really fooling themselves into thinking this one's going to be bigger than Bitcoin? Is that the phenomenon? Or is the phenomenon, I'm going to bet against or bet on culture. I'm going to be smarter than the next guy. This is PvP servers all day. And I'll just know when to get out.
Yeah, I think that makes sense. I think that a lot of that is PvP. I think when you put it in a publicly traded vehicle, it gets a little bit more potentially serious, or the scale's bigger. But yeah,
so those guys, you really think, like, that's wild to me. First of all, I didn't know that there were companies using an altcoin treasury like approach. Obviously, if they created their own coin, sure, but that seems insane. Is this a thing that's happening a lot? Like, are there any altcoins that you could point to and be like, well, that was smart? I mean, maybe Solana, but like, woof. Other than that.
Yeah, I think a lot of them can make good trades, but I think that none of them really have the quality of a treasury asset, which is different. Basically, it's something that I think there's a difference between like a hedge fund holding a trade versus a publicly traded company using it as a long-term treasury asset. I think Bitcoin has met that standard. I don't really view others as having met that standard. I think they're more like penny stock tech plays, basically, where, for example, I'm on the record of being bullish on stablecoins. So obviously, any sort of rails that enable stablecoins to function have some degree of value. So I think it's not to say that there's no value in the space, but generally speaking, it's inflated because there is this really big speculation element and this PvP element kind of built on top of it. And so I think over time, you've kind of seen the narratives play out. And now the narratives in that whole space are pretty weak outside of stablecoins and certain other forms of tokenization.
Do you use debt to buy Bitcoin?
I do not, but I've been long MicroStrategy since 2020. I treat it as a much smaller position than core Bitcoin. And then anyone who has optional leverage that doesn't get rid of it is in some ways using leverage to buy assets. So, for example, I have purposefully I have mortgages attached to properties because if I can short fiat currency at 3% for the long term, I figured instead of selling stocks or selling Bitcoin to pay that off, I'm kind of indirectly slightly levered on assets. But for the most part, I let other proxies do it for me. I let MicroStrategy do that for me rather than myself hold Bitcoin in debt.
And do you have a philosophical stance that you use to explain to yourself or to other people, like, this is why I don't go all in like Michael Saylor? Because if Saylor is right, he is going to make himself one of the wealthiest people on planet Earth. Like, if this continues to 10x from here or more, like, he's really, really going to be upper echelon of wealthy. Not that he isn't already, but I mean, it will just be absolutely absurd. But boy, oh boy, the reason I don't do it is I just don't trust myself to be that kind of right. While I have high risk tolerance, clearly not that high. And there could be a black swan event or whatever. And so I just, as a philosophy, go, I'm going to spread myself across a broader basket of risk on assets, to be sure. But I want that more diffuse take, because who knows?
Yeah, so my approach is, when I'm very high convicted bullish on something, I size it so that if I'm right, I materially benefit from it. But if I'm wrong, it's not like a financial kill shot. It's just a major setback. And so with Bitcoin, it is my largest individual asset, but it's one of many assets. And there's also a difference between someone who, say, sticks half their net worth in Bitcoin versus someone who bought some Bitcoin and then, because of superior performance, it's become half of their net worth. And they psychologically treat it somewhat different. So I have a lot of Bitcoin exposure, but it's in that kind of broader mindset of, more broadly, that I want to own multiple types of high quality assets, short fiat currency where I can, or let other, let my assets do it for me on their balance sheets. And I think that, to quote Paul Tudor Jones, I think Bitcoin is the fastest horse in the race. But I don't think it's the only horse. And I think that I have a clearer head by not being 100% in on something. It gives me kind of a Zen aspect in bear markets. So, for example, in November 2022, when Bitcoin had collapsed from 69,000 all the way down to like 16,000, I was at the Pacific Bitcoin conference, and we were having a good time. We were on stage, we were laughing. The energy there was high, and I think because, one, people knew what they own, and two, anyone who wasn't levered or didn't size it inappropriately relative to their volatility and risk expectations, use it as a buying opportunity. So I think it makes sense for someone to be all in, but not necessarily everybody, and not even necessarily most people, is how I put it. Another way of kind of pointing out is that Michael Saylor does have other assets in his personal life. He does have properties and things like that. And this particular vehicle obviously represents the vast majority of his net worth. But he'd still be okay if Bitcoin had a problem. So I think people, you want to put yourself in a position where, if Bitcoin doesn't perform the way you think you will, it could be, obviously very damaging to someone financially, but it's not necessarily an irrecoverable thing. if they encounter an issue. And it's going to partially depend on their level of conviction and their level of research that they've done on it.
Yeah, agreed. Do you see the volatility of Bitcoin coming down, and would you celebrate that or be sad?
So historically, it has mildly decreased cycle after cycle. And I think that's normal. I think that when you go from a $1 million asset to $1 billion asset to $1 trillion asset, it's naturally that the holding of it gets more diffused, and there's kind of less kind of tail optionality going on. So I think that over the next 5-10 years, I do expect volatility will decrease, and I view it as a good thing because as it kind of gets higher toward its total addressable market, we'd expect volatility to decrease. And also part of why people don't use it for payments at scale is that volatility. So you can't really price things in it because of that high volatility. We still live in a very fiat world. Our liabilities, either in debts or in just ongoing obligations, rent, mortgages, things like that, our expenses are in fiat currencies around the world. So people can't really price things in Bitcoin. If Bitcoin does get much larger and more liquid and the volatility goes down, that actually opens the possibility where people could price things more readily directly in Bitcoin, especially when you're talking about a context where, a continent with 40 currencies, and it can become more of a standard that people use. So I do expect volatility to decrease. And while the downside is it takes away from the explosive return potential over time, I think the upsides outweigh it. But I also think we have much more to go, most likely, before that volatility gets, to what we consider low, like gold.
And do you think that there's going to be tax policy that will need to be put in place to make it so that you can transact at least at smaller dollar amounts before you get taxed for this to really become that settlement layer? Or do you think it doesn't matter?
I think that does matter. I think that there's a significant number of people that would spend more Bitcoin if they didn't have this administrative or tax overhead on top of it. That'll be jurisdiction by jurisdiction. So there's some countries that will be ahead of the game in terms of getting away from that, and other ones that'll be more reticent. It also generally should fuel innovation because right now our payment systems are very much permissioned payment systems, and we have software now. We have open source, decentralized, permissionless things to build on. And so, tax can sometimes get in the way of that by basically saying that, this would be an easier way to do it, but because of tax, we can't. That's also, I think, part of what keeps stablecoins pretty attractive at the current time, not just the stability, but also because there's less of a tax overhead if you're just using it for holding and spending. But over time, I think that actually will be important. And for example, when people were kind of advocating the government to buy Bitcoin, I think a better policy is to let people use Bitcoin more easily. So I would actually be more interested in the politicians saying we want to, have a certain threshold for which Bitcoin transactions are not taxable versus telling me how much Bitcoin they want to buy on behalf of the government.
And are you getting nervous is probably the wrong word, but do you get tense at all about governments starting to have huge stakes in it, different companies buying big stakes in it? I know there are some people that are, they don't love that this is becoming a part of the traditional financial system. They wanted it to remain just completely outside of that.
So I think there's no world where it gets to be a multi-trillion-dollar asset and only individuals own it and not other pools of capital. I think that basically once you get this big and liquid, it's inevitable that either corporate entities or pension funds or even some sovereigns are going to want to own it. Basically anything that you're responsible for managing, if you become bullish on Bitcoin, it makes sense for you to add it to your thing. So that starts at the yourself and your family, and then it trickles into professional life for those managing other types of assets. So I think it's totally inevitable that if it's going to be successful, it's going to be in all these different types of balance sheets. As far as concentration risk, I don't really view that as a problem because it's a proof of work network, not a proof of stake network. And the concentration is thus far pretty manageable. So MicroStrategy has 3% of coins, roughly speaking. Potentially the more bigger concern is that a lot of entities use Coinbase as custody. So I think they have something like 10% of coins, which is not fantastic, but I think not the end of the world. People have to kind of remember that even back in say 2011, like with Mt. Gox, at one point they had like a double-digit share of the network. So there's always been these little pockets of concentration that spin up, and then either get diffused or break in some capacity. So I think that the network is sufficiently spread out that that's not really a long-term concern I have. And I generally view it as inevitable. There are people that say that Bitcoin has in some way failed now because these large entities hold it, but it's a permissionless asset. There's no way to prevent large pools of capital from owning it. And to the extent that the Bitcoin proponents that think it'll change the world, part of that involves going through every balance sheet out there, including increasingly big ones. It even goes back to in 2010 when the late Hal Finney was writing about this. He was kind of doing back of the envelope math on saying, Bitcoin has this many transaction throughput, and if this many people want to own it, they're going to have to own it through proxies. So he was kind of analyzing the concept of Bitcoin banks back then. So this has been kind of a known aspect from the beginning. And another one, Nick Szabo, he was one of the before Bitcoin came out, he was active in the field of kind of trying to create digital gold and other types of assets like this. And the way he envisioned it was a two-tier system where you have kind of a settlement network itself that's suitable for larger transactions, and then various mechanisms on top of that, whether it's software like Chalmy and Mints, or whether it's old school, just custody arrangements to allow smaller transactions and other things to scale. So I think that some degree of custody is inevitable, and some degree of connection between Bitcoin and everything else is inevitable. Again, as long as it's successful. I mean, if it's not successful and it just kind of rolls over, then it doesn't get into balance sheets. But as long as it continues to be dominant at what it does, and as long as it continues to be decentralized and secure, I think it will show up on more and more types of balance sheets, and it's mostly a one-directional thing.
Given the obviousness of fiat dysfunction, why do you think more companies don't have like treasuries that are Bitcoin? I mean, you don't necessarily have to become a Bitcoin treasury company, but why aren't more people going, thank you for the fiat, I'm going to immediately move this over into Bitcoin, or some at least meaningful percentage? Why isn't that happening?
So I think until the past year, a big variable was it wasn't taxed well. Basically for not tax, I mean accounting. Like it wasn't treated on accounting purposes very well. So basically, if it went down in price, they had to book that as a loss. But if it went up in price, they couldn't book that as a gain. So it just kind of ratcheted down. So they'd have to say, okay, here's our official financials, but here's like really what our financials look like, and that's not attractive to a lot of CEOs. In addition, because it's volatile, there's a lot of career risk where if you're already CEO of a company, buying an asset that can go down 80% at certain times and introduces risk where they might not otherwise want it. Historically, the way the company's been dealing with this whole fiat debasement issue is they decapitalize themselves. They pay out dividends, they buy back their own shares, they purposely take out debt they don't need just because they're basically shorting the fiat currency. Like an example I like to use is that Coca-Cola has been profitable for like every year for like a century. And yet, why do they have 40 billion or 50 billion in debt? And it's because they can. Basically, that if someone's going to offer them the ability to, issue bonds for 10 years, 20 years, 30 years at 2, 3, 4%, which until kind of recent high rates they were able to do, it's lower than their other cost of capital. They say, well, if we're going to borrow at 2% and buy back our own shares with it, they're arbitraging the fiat currency system just like everyone else. They're just doing it in a less volatile and explosive way as doing it with Bitcoin. And so that's been kind of the go-to choice for a lot of companies. Whereas Bitcoin is one, until recently, it wasn't really big and liquid enough to be on their radar. Then the accounting issues were there. And once those things were addressed, like now that it's a $2 trillion network, now that the accounting issues are addressed, we do see it popping up more. But I still think it'll take years because of the high volatility aspect of it, which means that it's more disposed that someone who owns a lot of the company. For example, Michael Saylor had dominant voting rights in the company. So if you're able to convince one person to make a really decisive move, that's where that tends to show up. It's also, I think, not an accident that Fidelity was earlier into Bitcoin than most other financial institutions, because that's a more privately held entity. So if the CEO was on board with it, it could happen. Whereas if you have a more diffused ownership where the CEO might only own 2% of the company, and is basically just an employee there rather than like a true owner, you're less likely to get that kind of high conviction decision making compared to entities that have tighter ownership. That's also why you see a lot of small businesses, small private businesses will own Bitcoin. And you'll see a lot of people that are, they might be on the board of a pension, they might be on the board of a bank, and in their personal life, they might have a lot of Bitcoin because they can just make that decisive decision. But there's no one really in place at a lot of these types of entities that can just make a pretty decisive call like that if there's any degree of controversy to it, which there is because of the volatility and historically because of the accounting treatment.
Fair. Now, do you think in terms of long-term potential risks for Bitcoin that quantum could present a problem?
Over the long arc of time, I think it's worth monitoring. I've been able to talk to some of the experts that focus on this, so they kind of come up with their potential solutions and how they might address it. So just like how USB and Ethernet update over time, Bitcoin does update over time. In terms of non-consensus changes, there's regular updates. And then in terms of consensus changes, there's occasional updates that happen over time if a very large percentage of the network agrees to do it. And potentially they could replace the signature types with more quantum resistant signatures. The downside is they generally take a lot more space. And therefore you run into issues like the block size limit, the amount of bandwidth that is needed. So doing it prematurely is unlikely to be successful because there's going to be more pushback against the cost of that compared to doing it. So I think I'm optimistic that I know that there are solutions on the table. They might be just like how we talked before about the complexities of the fiscal budget, that there are solutions. They're just kind of hard to arrive at. The same is generally true for Bitcoin and quantum resistance, that if we do hit that point, there are solvable ways around it. And then, I still think it'll take many years to probably reach that point.
Okay, so that fingers crossed that you were correct there, and that's sort of where I've settled out as well. If you were talking to the average person right now, the person that is getting eaten alive by inflation, that the stuff that we were talking about at the beginning, they're just not super aware. How would you coax them into making a change in their life? So I always try to leave people with a playbook, like go do this. You gave us your 3-pillar strategy, but for people that are like, they don't even understand the difference between the 3 pillars. Do you have like a basic way for somebody to think about this to move forward?
Sure. I would say that for any asset you own, think of the dilution. So if you're owning fiat currency, and the currency supply is growing by 7% per year, you're owning a smaller and smaller share of that network. Equities and real estate have different dilution rates. So for example, real estate might have a 1 or 2% long-term dilution rate. Gold has something like a 1.5% long-term dilution rate due to new mining. So for any asset that you consider owning, a first step is to know the dilution rate, both in terms of the number of units, if you can, and also market share. Is it kind of being diluted because it's losing market share in a big thing? So I think the main thing is to own truly scarce things that are then not being diluted. So high quality equities, high quality real estate, precious metals, Bitcoin, whatever kind of how much research they've done, they might be more convicted in certain areas than others. And for Bitcoin, I think my advice tends to be that there's a lot of numbers that make sense, but 0 is probably not the right one, which is to say, there are people that are more than 100% all in, like they're levered long. And there are other people that a 3 or 5% allocation could make sense. But I think that if you don't own any, and if you've never sent a Bitcoin transaction, I do think that going forward, that's a good thing to have done. It's a good thing to have, at the very least, you've educated yourself on the functionality of this, basically a different way of doing money. And I do think that going forward, just 0 is not the right number. It could be an amount that's not that important to you, but at least you have skin in the game now and maybe would pay attention to it going forward.
I think that is very sage advice. Now, you talked about market share and that being one of the things you need to pay attention to. Market share as it applies to the dollar. Do you see any realistic challenge to dollar hegemony? Is that on your risk of things to be worried about? Or are you like, no, listen, inflation, yes, we have to worry about that very much, but the dollar is going to be the reserve currency for a very long time?
I think we're seeing gradual diffusion because people, when they think about dollar losing status, their immediate thought is what replaces it. And the answer is that there's no other fiat currency that has the characteristics to replace the dollar. And so, for example, after World War II, the United States was like over 40% of global GDP. We had all the manufacturing base. Yeah, we had all the gold. We were the only entity still standing, basically. Everything else was rubble. And so you're in this kind of unusually dominant position. And we've been able to ride that now for 80 years. And so the U.S. is no longer in a position that's anywhere near that dominant. We're a quarter of global GDP on a purchasing power basis. We're even less, something like 15% on a purchasing power parity basis of GDP. But also China's not big enough. Europe's not big enough. There's no other currency block that's really in a position to just be the global ledger that everyone uses. So I think that the challenge on the dollar is not going to be another fiat currency. It's going to be one of two things. It's going to be a more of an interest in neutral assets, so things like gold and Bitcoin. Currently, by far, because gold's 10 times bigger, that's the preference that central banks have been doing over the past decade or so, where they're gradually kind of bringing gold back into the system to some extent. Even some of them were repatriating it because they were like storing it abroad, and some of them were actually paying the expense and logistics of getting it back in their own borders. And then around the margins, there are some like El Salvador, the Kingdom of Bhutan, that get Bitcoin on their balance sheet, or in certain sovereign wealth funds, they have indirect exposure. So I think that will become more common. And then two, there can be more of a diffusion of currencies where there's no one currency that displaces the dollar. Let's say the Chinese currency goes from a 0% holding to a 5% to a 10% holding, for example, and you get more of this plurality, especially I think that basically that whole the whole region around Asia is probably, I think, going to gradually a little bit get more in China's orbit over time, which I don't necessarily view as a bad thing, because I talked before about the dollar hegemony has a cost to it. We overvalue our currency. And to maintain that status, we basically hollow out our industrial base. We run these big trade deficits with the rest of the world to get them dollars, because in order to use the dollar as a global reserve currency, they need dollars. And ironically, they get them through our trade deficits. So I think that as we enter a more multipolar world, either because neutral reserve assets are more popular or because there's some degree of diffusion among the top 5 or so currencies, that actually takes some of the imbalance away from the U.S. economy. And going back to my earlier point, if that's kind of acknowledged to be happening, there are ways to kind of make that transition more graceful than if they try to fight back and fully maintain hegemony, even when it's no longer even serving our interests anymore. So I think that's kind of the big risk there.
That is very interesting. Very interesting. Okay. I definitely not thought of it that way. That is fascinating. Lyn, this has been incredible. I have so enjoyed my time with you. Where can people engage with you?
People can check out my book, Broken Money. They can go to lynalden.com and see my work there. I've a bunch of free articles that people can check out. And I appreciate the opportunity and I enjoy the conversation.
Oh, truly. Boys and girls, if you are not already, trust me, you're going to want to follow Lyn very closely. Such an incredible voice in the space. And as you guys just saw over the last 2 hours, exceedingly insightful on the, every aspect of the economy at this point. Lyn, thank you so much again for your time. Boys and girls, if you have not already, be sure to subscribe. And until next time, my friends, be legendary. Take care. Peace. If you like this conversation, check out this episode to learn more. America is in a precarious position. We show no signs of being willing to cut spending, so without massive growth, we will go bankrupt. But where is that growth going to come from? We're supposed to be the ultimate deal maker on the global stage. We're supposedly the ones holding all of